Phocuswright. I am a real estate guy. I started out putting deals together in my dorm room at Harvard, and after a few years, I quit a fast-track job at Goldman Sachs to where I was trading complex financial products to follow my dreams and come home to Southwest Atlanta to rebuild rundown apartments in my old neighborhood. And after 10 years of owning and managing all kinds of properties, I've learned that there's really only one business model in the real estate game. And that is, you get a bunch of money, you use it to buy or improve a building, and then you get a little cash flow every month until you sell it. If you want to grow your business, you have to find another pile of money. And that usually means either draining your savings or finding equity investors. And let me tell you a little secret about real estate. It's set up where real estate entrepreneurs like myself end up equity rich but cash poor because their capital is trapped in their properties. This is a position that so many real estate professionals face. Building and running a real estate portfolio is capital intensive, and that capital is expensive and hard to get. For all of you real estate investors out there, what if you could stop asking other people for money and instead get years worth of your own cash flow in a lump sum today? My name is Derrick Barker, and I am the CEO of Nectar. Nectar is a platform that turns the fee income or net cash flow that vacation rental managers or owners are making into a single cash advance to help them scale or improve their portfolio. This model is part of a broader change in the way that the financing is being done. Vertical financing is becoming the wave of the future, with companies like CapChase in SaaS or Wayflyer in e-commerce providing specialized financing solutions for their respective industries. And since we launched, we've learned that the need for specialized financing products in the real estate industry is deep and broad. And we specifically focus on short-term and vacation rental space because these properties generate a ton of cash flow and they have relatively few financing options. So here's an example of a South Texas STR operator with 150 properties, a professional team, very strong portfolio. He used Nectar to access $1 million to finish a renovation while maintaining the cash requirements to refinance an expensive bridge loan. Here's another operator, 12 units, took out a $200,000 advance on his property and asset management fee income, and then another $150,000 in advance from the net cash flow from his own properties to upgrade a portion of his portfolio while bringing on a couple of new units. Both of these operators were able to connect their accounting software and bank accounts to verify their net cash flow, answer a few questions, and through our proprietary, through our proprietary tech-enabled underwriting process, they were able to get an instant estimate, and upon acceptance, they were able to access funds in less than 6 days from start to finish. Nectar makes money by charging an 8 to 15% annual fee on the cash that we advance. We reach our customers through referrals and affiliate marketing relationships with the top brokers and service providers in the short-term rental industry. And this year, 80% of our customers have applied for additional funding. Last year, we did almost $600,000 in transaction volume during our first couple of months in operations. In 2022 so far, as of Q3, we had done over $5 million in deal volume. And Q4 is on track to be our biggest quarter yet, with $2.5 million currently in our underwriting queue. And despite the current market conditions, we raised $2.8 million in seed funding, and have closed a $25 million credit facility with Corbindale Capital to take our financing product to the broader market. This reflects the validation of the strength of our underwriting process and the quality of the operators who are looking for alternative financing as banks tighten up their underwriting processes. Our current target customers are professional short-term rental owners and managers. They're generating $42 billion a year in net cash flow, which corresponds to $8.3 billion in total potential revenue for Nectar. But our vision is to become the go-to financing solution for real estate entrepreneurs across all categories, where any operator, whether they operate apartments or solar farms or billboards, they get the cash they need without raising equity from investors. And we are the perfect team to create a big business in this space. I built a portfolio worth over $350 million in real estate assets. My partner, Brittany, ran a $120 million retail portfolio before building a 125-unit short-term rental portfolio. And she's been a superhost since 2017. We intimately understand the challenges of building and operating a fast-growing short-term rental business. We know how operations need to look and the challenges to financing those operations. So, and we're hiring. So come join us in our journey to bring fast and flexible common sense financing. Yeah.
Thank you, Derrick. Audience, what did you think? Another green wave. Well done.
Yeah.
Wow.
Dragons.
Well, if you don't mind, I'll jump in. So I love this idea, and I think that, I had the opportunity to speak with you a bit at lunch yesterday, so I have a little bit of a head start. But let's sort of drill in again on your specific economics. Talk about how you make money, how big you have to be actually an attractive equity investment.
So how we make money is we borrow at a cost of capital between 12 and 15%, and we lend out, and we're making between 20 and 35% IRRs in the dollars that we lend out by charging this financing fee and just having straight line amortization. How big do we have to be attractive? I mean, for every dollar that we put out, we make 15 cents, if that makes sense.
For now, but these kinds of economic arbitrage, right, opportunities eventually close, right? If you believe that capital is efficient, how do you protect from margin squeeze 5 years from now?
I was a structured bond trader at Goldman Sachs and can assure you that capital is not efficient.
Fair point.
That being said, look, banks right now, if you look at, they get deposits where they're paying 0.5%, and they're lending out at 7-8%. Like, how has that arbitrage not disappeared? When it comes down to it, it's the arbitrage is there for a reason. It's because it's hard to underwrite. It's hard to get the data. You have to pick the right sponsors. You have to know what you're doing. And these people right now, the only option right now is equity that most of the time they're getting from family or friends in their own community. Like, that's inefficient.
Yeah.
Like, that's a competitor I would love to face.
So your growth is kind of limited by the size of the credit facility you can get, right? And we're heading in a time that may get pretty tough. Mm-hmm. So what's going to happen to you? Do you think you can continue to grow that credit facility in order to have the cash?
All these lenders have money, and they want to make returns so they can get bonuses at the end of next year. And our default rate is 0%. So with this track record, with the people that we're giving money to, if you look at their portfolios, impressive. Top 1 to 3 operators in their market, they're dominant. And we're lending out in our coverage ratio. That's our target metric. That's the dollars that they're making net cash flow over the dollars that they have to pay to us. It's 2x. So we're incredibly covered. We have to see 40% declines in revenue for us to really get into trouble.
It's interesting, you talked about the financial institutions tightening up their, underwriting process. Why are they willing to lend to you when they're tightening up, right? Why wouldn't they prefer to lend directly to the property owners?
Well, firstly, banks are just not set up to do this type of, they're used to doing asset-based underwriting.
Yeah.
What's the value of the property? Let's get an appraiser out there to tell me, because I can't, do the underwriting myself. Okay, I'll give you 80%, 70% of that. And if interest rates go up and we're scared, we're going to say, okay, instead of 80%, we'll make it 60. We don't have to underwrite. We just know we'll be better off. It's a scarier time. We're taking less risk. That's how they think about it. We're using data and nuance and technologies to say, hey, these are who you should be giving money to based on their performance, not based on our
The value of the asset.
Thank you very much, Derrick. Well done.
Brilliant.